Imagine a dying company, stores closing, revenue declining, employees losing jobs, Wall Street predicting bankruptcy, hedge funds betting billions that this company will fail. Now imagine that company becoming the center of the greatest financial battle between retail investors and Wall Street in history. This is the story of GameStop, but not the story you think you know. Not the story of January 2021 when the stock went from $20 to $483 in a matter of days. Not the story of Robinhood shutting down trading or congressional hearings. This is a story of how it all began, the setup, the discovery, the moment when a few people realized that Wall Street had made a catastrophic mistake, and that mistake would cost them billions. GameStop. If you're over 25, you probably have memories of this place. Walking into the mall, heading straight to GameStop, browsing rows of video game cases, trading in old games for store credit, pre-ordering the next big release. For millions of gamers, GameStop was a ritual. The company was founded in 1984 in Dallas, Texas. Originally called Babbage's, it eventually became GameStop in 1999. At its peak in the late 2000s and early 2010s, GameStop had over 6,000 stores worldwide. It was the place to buy physical video games, consoles, and gaming accessories. But then everything changed. Digital downloads, Steam, PlayStation Network, Xbox Live. Why drive to a store when you could download games instantly from your couch? The industry was shifting, and GameStop was on the wrong side of history. By 2019, GameStop was in serious trouble. Stores were closing by the hundreds, revenue was declining year after year. The company had gone through multiple CEOs trying to turn things around. Nothing worked. Mall traffic was dying. Physical game sales were plummeting. The business model was becoming obsolete. Wall Street smelled blood, and when Wall Street smells blood, the sharks circle. They don't just watch a company die, they profit from it. They bet against it. They short it. Disregard short selling because it's crucial to understanding this entire story. When you normally invest in a stock, you buy it hoping the price goes up. Buy at $10, sell at $20, make $10 profit. Simple. Short selling is the opposite. You're betting the price will go down. Here's how it works. You borrow shares of a stock from someone else, usually through your broker. Let's say you borrow 100 shares of a stock trading at $50. You immediately sell those borrowed shares and pocket $5,000. Now you wait. If the stock drops to $20, you can buy back those 100 shares for only $2,000. You return the shares to whoever you borrowed them from, and you keep the $3,000 difference as profit. You made money by betting against the company. But here's the risk. If the stock goes up instead of down, you're in trouble. Let's say the stock goes to $100. Now you have to buy back those shares for $10,000. You sold them for $5,000, but you're buying them back for $10,000. You just lost $5,000. And here's the terrifying part. Your potential loss is unlimited. If you buy a stock normally, the worst that can happen is it goes to zero and you lose your investment. But with short selling, the stock can theoretically go up infinitely. If that stock goes to $500, you're buying back shares for $50,000 that you sold for $5,000. You just lost $45,000. This is why short selling is risky. This is why it's usually done by sophisticated hedge funds and professional traders who supposedly know what they're doing. And this is why what happened with GameStop was so catastrophic for Wall Street. Blackmail. Back to GameStop. By 2019 and early 2020, the stock was trading around $4 per share. The company was worth less than $300 million total. For context, that's tiny. Individual people have more wealth than the entire GameStop company was worth. Quickest Funds looked at GameStop and saw an easy target, a dying retailer with no future. They started shorting the stock aggressively. Melvin Capital, one of the most prominent hedge funds, took a massive short position. Other funds followed. They were all betting GameStop would go bankrupt. But they got greedy, really greedy. They didn't just short some shares, they shorted more shares than actually existed. This is called having a short interest above 100%. At one point, GameStop's short interest was over 140%. Let me explain why that's insane. If a company has 100 million shares outstanding and short sellers have borrowed and sold 140 million shares, they've somehow shorted 40 million shares that don't exist. This happens through reborrowing and complex lending chains, but the bottom line is they've created a massive artificial supply of shares. This is important because of something called a short squeeze. Remember, short sellers eventually have to buy back the shares they borrowed. If something causes the stock price to start rising, short sellers might panic and try to close their positions by buying shares. But when they buy, it pushes the price up more, which causes more short sellers to panic and buy, which pushes the price up even more. It's a feedback loop, a chain reaction. And when the short interest is above 100%, there literally aren't enough shares available for all the short sellers to close their positions without sending the price to the moon. Wall Street knew this risk existed. They knew that shorting more than 100% of a company was dangerous, but they were so confident GameStop was going bankrupt that they didn't care. They thought there was zero chance the stock would go up significantly. They were wrong. Enter Ryan Cohen. If you don't know who Ryan Cohen is, you need to. This man is central to the entire GameStop story. Ryan Cohen co-founded Chewy.com in 2011. Chewy is an online pet supplies retailer. Think Amazon, but just for pets. Kang built Chewy from nothing into a billion-dollar company. He understood e-commerce. He understood customer service. He understood how to compete with Amazon. In 2017, he sold Chewy to PetSmart for $3.35 billion. Ryan personally made hundreds of millions from the sale. So now you have this young, successful entrepreneur with a proven track record and a lot of cash. What does he do next? He starts looking for his next investment opportunity, and he finds GameStop. Ryan looked at GameStop and saw something Wall Street didn't. He saw a company with a loyal customer base, a recognizable brand, and a massive opportunity to transform. Yes, physical game sales were declining, but gaming as an industry was exploding. Esports, streaming, gaming hardware, collectibles, PC gaming, all growing massively. Ryan believed GameStop could pivot, could become the Amazon of gaming, could offer same-day delivery, PC gaming products, gaming furniture, streaming equipment. The stores could become experience centers. The possibilities were there if the company had the right leadership and strategy. Backstage 2020, Ryan Cohen started buying GameStop stock, a lot of it. He eventually accumulated a 9% stake in the company, making him one of the largest shareholders. In November 2020, he sent a letter to GameStop's board of directors, outlining his vision for transformation and criticizing the current leadership. This was huge news. A successful entrepreneur and activist investor was betting big on GameStop. This wasn't some random person. This was someone who had built a billion-dollar company and knew what he was doing. Maybe GameStop wasn't dead after all. But Wall Street largely dismissed it. Sure, Ryan Cohen was different. Retail was dying. Malls were dying. Physical games were dying. No amount of e-commerce pivoting could save a fundamentally flawed business model. The shorts stayed on. Now we need to talk about Keith Gill, known online as Roaring Kitty on YouTube and Deep Fucking Value on Reddit. Keith is the other main character in this story. Without Keith Gill, the GameStop short squeeze might never have happened. Keith Gill was a regular guy. He worked as a financial analyst at MassMutual, an insurance company in Massachusetts. He had a wife and a young daughter. He lived in a modest home. He wasn't rich. He wasn't a Wall Street insider. He was just a guy who loved investing and analyzing stocks. Keyboard had a YouTube channel where he'd stream himself analyzing stocks and discussing investment ideas. His streams were low budget, just him in a headband, sitting in his home office, talking to a small audience about value investing. He idolized Warren Buffett and believed in finding undervalued companies. Plagued in mid-2019, Keith started researching GameStop. He looked at the fundamentals, the balance sheet, the cash flow, the valuation, and he came to a surprising conclusion. GameStop was ridiculously undervalued. Yes, the business was struggling, but the stock was trading at $4. The company had over $5 per share in cash alone. It owned valuable real estate. It had a massive customer database. The brand was worth something. Even if the company was in decline, it was worth more than $4 per share. Keith also noticed the short interest, over 100%. He understood what that meant. If anything positive happened with GameStop, if there was any catalyst to push the stock up, the short sellers would be forced to cover, and with that much short interest, it could trigger a massive short squeeze. So Keith made a bet. In June 2019, he invested $53,000 in GameStop call options. Call options are leveraged bets that a stock will go up. If he was right and GameStop went up significantly, his $53,000 could turn into millions. If he was wrong and the company went bankrupt, he'd lose everything. Keith posted his position on Reddit, specifically on a subreddit called Wall Street Bets. This is important. Wall Street Bets, often abbreviated as WSB, is a subreddit that had existed since 2012. It's a community of retail investors who share risky stock plays, celebrate big wins, and mock devastating losses. Is unique. Users call themselves degenerates, apes, and retards. Their words, not meant offensively, but self-deprecatingly. They post memes, use phrases like diamond hands, holding through volatility, and paper hands, selling too early. They worship risk-taking and ridicule conventional investing wisdom. When Keith posted his GameStop position on Wall Street Bets, most people thought he was crazy. GameStop? That dying retail store? You put $53,000 into that? Many comments mocked him. Some wished him luck. A few people started looking into his analysis. Keith kept posting updates. Every few weeks, he'd share a screenshot of his brokerage account showing his GameStop position. Sometimes it was up, often it was down. He never sold. He held. He believed in his thesis. Kept making YouTube videos explaining his GameStop analysis. He'd go through the financials, discuss the short interest, talk about the potential for a turnaround. His videos were detailed and thoughtful. He wasn't pumping the stock. He was sharing legitimate analysis. Slowly, a few people started paying attention. Other Wall Street Bets users started looking at GameStop. They read Keith's analysis. They noticed the insane short interest. They saw Ryan Cohen buying in. Wait, maybe this isn't as crazy as it seems. By late 2020, GameStop started getting more attention on Wall Street Bets. More people were buying shares and call options. The subreddit had grown from hundreds of thousands of users to over 1 million. There was a growing sentiment that GameStop could be a huge opportunity. The stock started moving. In August 2020, GameStop was trading around $4. By December 2020, it was around $16, a 400% increase. Keith Gill's $53,000 investment was now worth over $1 million. He posted an update showing his gains. The Wall Street Bets community went wild. But this was just the beginning. The short sellers were still holding their positions. The short interest was still above 100%. They hadn't covered. They were doubling down, borrowing more shares to short, convinced the stock would crash back down. Discharge the powder keg. You had massive short interest, you had a growing community of retail investors convinced GameStop was undervalued and could squeeze, you had Ryan Cohen, a credible activist investor pushing for change, and you had Keith Gill, now called DFV or Deep Fucking Value, posting regular updates that inspired thousands of people to buy and hold. In January 2021, Ryan Cohen officially joined GameStop's board of directors. This was the catalyst. The market reacted immediately. GameStop's stock jumped. Short sellers started getting nervous. Some began covering their positions, which pushed the price up more. The Wall Street Bets community saw what was happening. The short squeeze was beginning. Posts flooded the subreddit. Hold the line. Diamond hands. We like the stock. The community rallied around GameStop. It became a movement. But it wasn't just about making money anymore. It became about sending a message to Wall Street. These hedge funds had shorted more than 100% of GameStop. They were betting on the company's failure, which would result in people losing jobs. They were making billions by destroying companies. Wall Street Bets users saw an opportunity for revenge. For years, Wall Street had rigged the game. The 2008 financial crisis had destroyed millions of lives and barely anyone went to jail. Hedge funds made billions while regular people suffered. Now, finally, retail investors had a chance to beat Wall Street at their own game. The narrative became David versus Goliath, regular people versus billionaire hedge funds, the internet versus Wall Street. It was personal, it was emotional, and it was about to explode. 2021, GameStop was trading around $40. Keith Gill's position was worth over $10 million. He could have sold and changed his life forever, but he held. He posted an update, "I'm not selling." The Wall Street Bets community took this as a rallying cry. If DFV wasn't selling, neither were they. More people bought in. The momentum was building. The media started noticing. CNBC ran segments about GameStop and Wall Street Bets. Mainstream attention was arriving. The short sellers were panicking. Melvin Capital, one of the largest short sellers of GameStop, was losing billions of dollars. The stock was going up and they were getting crushed. They needed to close their positions, but there weren't enough shares available. Every time they tried to buy shares to cover, it pushed the price up more. Other hedge funds started piling in, but on the long side. They saw the squeeze happening and wanted to profit from it. This added even more buying pressure. The stock went from $40 to $60, then $80, then $100. The short interest was still massive. The squeeze hadn't fully happened yet. Wall Street Bets users calculated that if everyone held their shares and didn't sell, the short sellers would have no choice but to keep buying at higher and higher prices. Theoretically, the stock could go to $1,000, $5,000, even higher. Come on, let me break down why this mathematics was so compelling to retail investors. When you have short interest above 100%, you've created an impossible situation. Let's say GameStop has 70 million shares outstanding. If short interest is 140%, that means 98 million shares have been borrowed and sold short. But here's the problem. There are only 70 million real shares. So where did the extra 28 million shorted shares come from? The answer is complex and involves shares being borrowed multiple times through different chains of ownership. But the bottom line is simple. There aren't enough shares for all the short sellers to cover their positions. This creates what traders call a squeeze potential. If the stock price starts rising and short sellers panic, they all rush to buy shares at the same time. But they're competing for a limited supply of shares. It's like musical chairs where there are only 70 chairs, but 98 people need to sit down. Someone is going to be left standing. And when you're left standing in a short squeeze, you can lose everything. Your losses are theoretically unlimited. The stock could go to $500, $1,000, or higher, and you're forced to buy at whatever price you can get. This is why short squeezes are so devastating. Wall Street Bets users understood this dynamic. They had done the research. They had read the academic papers on short squeezes. They knew the Volkswagen short squeeze of 2008 had briefly made Volkswagen the most valuable company in the world when the stock went from €200 to over €1,000 in 2 days. They believed GameStop could be even bigger, and the data supported them. Volkswagen's short interest had been around 12% when that squeeze happened. GameStop's was over 140%. This was unprecedented. This was a once-in-a-lifetime setup. The community adopted new mantras: hold the line, diamond hands, to the moon. Rocket ship emojis flooded every thread. People were buying more shares with every paycheck. Some people took out loans to buy GameStop. Others maxed out credit cards. The frenzy was real. But it wasn't just reckless gambling. Many people genuinely believed in the investment thesis. They had read Keith Gill's analysis. They agreed that GameStop was undervalued. They believed Ryan Cohen could turn the company around. The short squeeze potential was just the catalyst that could unlock that value faster. The culture of Wall Street bets also played a crucial role. This wasn't just about making money, it was about community. People posted screenshots of their positions, their gains, and their losses. They celebrated together and suffered together. There was a genuine sense of camaraderie. Users created elaborate memes, videos edited to show hedge fund managers as villains and retail investors as heroes, parody songs, artwork. The creativity was endless. This content spread across the internet, recruiting more people to the cause. There was also a strong element of spite and revenge. Many Wall Street Bets users were millennials and Gen Z who had grown up during and after the 2008 financial crisis. They had watched their parents lose homes, lose jobs, and lose savings while Wall Street got bailed out. They had graduated into a brutal job market. They had massive student loan debt. Now they had a chance to inflict pain on the hedge funds that represented everything they hated about the financial system. It wasn't just about getting rich, it was about making Wall Street feel what regular people had felt in 2008. It was about revenge. The language reflected this. Posts talked about eating the rich and making them bleed. There was genuine anger alongside the memes and jokes. This was personal. By January 19th, GameStop closed at $39. By January 22nd, it closed at $65. By January 25th, it closed at $76. The momentum was accelerating. Every day brought new highs. Trading volume was exploding. Normally, GameStop might trade 5 or 10 million shares in a day. Now it was trading 100 million shares or more every day. The entire market was watching. Traders who had never heard of Wall Street Bets were now paying attention. Subjected activity was insane. Call options, which are bets that the stock will go up, were being bought in massive quantities. This created something called a gamma squeeze, which adds even more buying pressure. When people buy call options, the market makers who sell those options have to hedge their risk by buying the underlying stock. This buying pushes the price up more, which makes more call options go in the money, which requires more hedging. It's another feedback loop on top of the short squeeze. Privilege there were creating a perfect storm. Short squeeze plus gamma squeeze plus retail buying plus FOMO from new dot investors who didn't want to miss out. The stock was a rocket ship and nobody knew how high it could go. Mainstream media was now fully covering the story. Jim Cramer on CNBC talked about it constantly. News articles tried to explain what was happening. Boomers and older investors were confused. How could a dying retail stock be going up this much? It didn't make sense. Quickest financial analysts went on TV to warn people. GameStop is not worth this much. This is irrational. People are going to lose money. Get out now while you can. But Wall Street Bets users didn't care. They understood something the analysts didn't. This wasn't about fundamental value anymore. This was about a short squeeze. And the squeeze hadn't squoze yet. Seizing the media also started profiling Keith Gill. Who was this roaring kitty person? Why did he bet everything on GameStop? Reporters dug into his background. He was just a regular guy, not a professional hedge fund manager, not a Wall Street insider, just someone who did his homework and made a bet. Metallic gave some interviews. He explained his thesis calmly and rationally. He wasn't trying to pump the stock. He had done legitimate research and believed GameStop was undervalued. The short squeeze potential was real, but it wasn't the only reason he invested. He genuinely thought the company had a future. Camouflage resonated with people. This wasn't some scam artist or stock promoter. This was a guy who believed in his analysis and put his own money where his mouth was. And he was still holding. Even as his position grew to $15 million, $20 million, he didn't sell. The Wall Street Bets community elevated him to legendary status. He became known as DFV, short for deep fucking value. People called him a legend, a hero, a god. His screenshot updates became the most anticipated posts on the entire internet. When he posted, the community would rally. His diamond hands inspired millions. But to the Wall Street Bets community, it made perfect sense. This was the short squeeze they had predicted. Wall Street had gotten greedy, shorted too many shares, and now they were paying the price. The little guys were finally winning. And it wasn't just Americans. The GameStop story went global. Retail investors in Europe, Asia, and South America were buying in. International news covered it. The entire world was watching a group of internet strangers take on Wall Street hedge funds. The psychology was fascinating. Traditional investing wisdom says you should be fearful when others are greedy, and greedy when others are fearful. But the Wall Street Bets community flipped this. They were greedy together. They fed off each other's enthusiasm. The more people who bought in, the stronger the conviction became. There was also a strong us versus them mentality. Hedge funds and the financial establishment were the enemy. Anyone who warned about the stock going down was labeled a shill or a paid actor for Wall Street. Dissenting opinions were downvoted and ridiculed. The echo chamber effect was powerful. Some people mortgaged their homes to buy more GameStop. Others quit their jobs so they could day trade full time. College students put their entire student loan refunds into the stock. These were not rational investment decisions by traditional standards, but the community celebrated them as acts of courage and conviction. Critics called it a cult. Supporters called it a movement. The truth was probably somewhere in between. But one thing was undeniable. This was unprecedented. Never before had retail investors coordinated on this scale to target a specific stock and take on institutional short sellers. The question everyone was asking, how high could it go? Some people thought $100 was the top. Others believed it could hit $500 or even $1,000. The most optimistic believers thought it could go even higher if everyone held. Financial models went out the window. Normal valuation metrics meant nothing. Price to earnings ratio? GameStop barely had earnings. Book value? Irrelevant. This was pure supply and demand dynamics. The shorts needed to cover. Retail was holding. The price would go wherever the market forced it to go. Some institutional investors started changing their tune. Chamath Palihapitiya, a billionaire venture capitalist and former Facebook executive, bought call options on GameStop and publicly supported the Wall Street Bets community. He went on CNBC and argued that retail investors had every right to coordinate and invest however they wanted. If hedge funds could short 140% of a company, why couldn't retail investors organize to squeeze them? Ping his support gave legitimacy to the movement. This wasn't just internet degenerates gambling. This was a legitimate challenge to Wall Street's power structure, and people with real money and credibility were taking it seriously. Elon Musk, the richest man in the world, tweeted about GameStop. Just one word, GameStonk, with a link to Wall Street Bets. The stock jumped in after-hours trading. Elon's involvement brought even more attention and legitimacy. If the CEO of Tesla and SpaceX was paying attention, this was clearly something significant. Photoshop was unstoppable. Every day brought new developments. Every day the price climbed higher. Every day, the short sellers lost more money. And every day, the Wall Street Bets community grew larger and more emboldened. Behind the scenes, though, serious problems were developing. The brokers that facilitated all this trading were facing massive operational challenges. Robinhood, the most popular trading app among retail investors, was experiencing unprecedented volume. Millions of trades per day. Their systems were straining. There was also something called clearinghouse requirements. When you buy a stock, the transaction doesn't settle immediately. There's a 2-day settlement period. During that time, the broker has to post collateral to guarantee the trade will go through. With GameStop's volatility and volume exploding, the collateral requirements were skyrocketing. Alphabet and other brokers were facing a liquidity crisis. They needed billions of dollars to meet collateral requirements. Some brokers started restricting trading in GameStop and other volatile stocks, but not yet. The restrictions would come soon, and when they did, they would change everything. Natasha, in late January 2021, the squeeze was building, the price was climbing, the short sellers were bleeding, and the retail investors were winning. It seemed like nothing could stop them. Firefox, the establishment, was panicking. Financial news networks ran segments warning about the danger. Hedge fund managers went on TV to complain about market manipulation and unfair trading. Regulators started discussing potential investigations. The entire financial system was watching a group of Reddit users potentially break Wall Street. But there was one problem nobody saw coming: the brokers, the platforms that retail investors use to buy stocks. Robinhood, TD Ameritrade, E-Trade, Webull. These companies were about to become the villains in this story. Let's talk more about the key players who made this possible. Ryan Cohen wasn't just throwing money at GameStop randomly. He had a specific vision. He wanted to transform GameStop into the Amazon of gaming, not just selling physical games, but becoming a destination for everything gaming related. PC gaming components, gaming chairs, streaming equipment, collectibles and merchandise, same-day delivery, competitive pricing, excellent customer service. Ryan had proven with Chewy that you could compete with Amazon by focusing on customer experience and building loyalty. He believed the same approach could work with GameStop. Psychologists, the gaming industry was massive and growing. In 2020, the global gaming market was worth over $150 billion. Esports were becoming mainstream. Streaming on Twitch and YouTube was huge. Gaming hardware was in high demand. The opportunity was enormous if GameStop could capture even a small percentage. Rancock Ryan Cohen also recognized that GameStop's existing store network could be an asset rather than a liability. While mall traffic was declining, the stores could be reimagined as local hubs for gaming communities, hosting tournaments, offering gaming lounges, becoming experiential destinations rather than just retail locations. This wasn't a fantasy. Other retailers had successfully pivoted by focusing on experience over transactions. Apple stores weren't just places to buy phones, they were community spaces with classes and support. Best Buy had survived the retail apocalypse by focusing on services and expert advice. GameStop could do something similar for gaming. Wall Street analysts dismissed this vision. They had seen too many retail turnaround stories fail. Sears, JCPenney, Toys R Us, all had tried to transform and all had ultimately failed or gone bankrupt. Why would GameStop be different? But Ryan Cohen had credibility. He wasn't some consultant with a PowerPoint presentation. He had actually built and sold a billion-dollar company. His track record made his vision believable to those willing to listen. And Wall Street Bets was listening. Keith Gill's analysis went even deeper than most people realized. He didn't just look at the balance sheet and the short interest. He studied the gaming industry trends. He analyzed customer sentiment. He looked at GameStop's market share and competitive positioning. His thesis was comprehensive. One thing Keith noticed was GameStop's Power Up Rewards program. The company had tens of millions of members in its loyalty program. That was a massive customer database. In the age of digital marketing and e-commerce, customer data is incredibly valuable. GameStop had millions of engaged customers who loved gaming. That was an asset Wall Street was completely ignoring. KG also looked at the potential for GameStop to monetize used games and trade-ins in new ways. Digital marketplaces for used digital games. Blockchain-based ownership that would allow resale of digital items. These ideas seemed far-fetched in 2019, but they showed Keith was thinking creatively about the company's future. His valuation work was thorough. He calculated different scenarios: best case, worst case, and most likely case. Even in his conservative scenarios, GameStop was worth more than $4 per share. The market was pricing in bankruptcy, but Keith's analysis showed the company had paths to survival and even growth. When Keith posted his analysis on Wall Street Bets, he wasn't trying to create a movement. He was just sharing his research with a community of like-minded investors. But his timing was perfect. The subreddit was growing rapidly. More sophisticated investors were joining. People were looking for unconventional opportunities. The Wall Street Bets community in 2019 and early 2020 was different from what it became later. It was smaller, more focused on actual analysis, and less mainstream. Users shared detailed due diligence posts. They debated investment theses. They challenged each other's assumptions. It was crude and irreverent, but there was real substance. As GameStop started moving in late 2020, the dynamic changed. More people flooded into the subreddit. Many were new investors who didn't fully understand what they were buying. They just saw the hype and wanted to be part of it. This created both opportunity and risk. The opportunity was that more buyers meant more buying pressure, which helped fuel the squeeze. The risk was that many of these new investors had weak hands. They would panic and sell at the first sign of trouble. For the squeeze to work, people needed to hold. But how do you coordinate millions of anonymous internet users to hold through extreme volatility? The answer was culture and memes. Wall Street Bets created a shared identity. If you owned GameStop, you were part of the movement. You had diamond hands. You were an ape. You were holding the line against Wall Street. This identity gave people a reason to hold beyond just profit. The memes reinforced the message constantly. Images of diamonds and hands, rocket ships going to the moon, apes together strong. These weren't just jokes, they were psychological tools that created solidarity and conviction. There was also public accountability. People posted their positions publicly. They showed they were holding. This created social pressure. If you sold, you were letting the community down. You were being a paper-handed coward. Nobody wanted that label. This coordination wasn't illegal, despite what some hedge fund managers claimed. There was no formal organization, no leader giving orders, just millions of individuals making their own investment decisions based on publicly shared information and analysis. It was the democratization of investing playing out in real time. The timing of Ryan Cohen joining the board in January 2021 was crucial. This gave the movement credibility just as momentum was building. It validated Keith Gill's thesis. It showed GameStop was serious about transformation, and it gave retail investors confidence that they weren't crazy for buying the stock. Short sellers now faced a real dilemma. The company had legitimate prospects for turnaround. The stock had strong buying pressure from retail. The short interest was still massive, and the price was climbing every day. Should they cut their losses and cover, or hold on and hope the stock crashed? Melvin Capital, led by Gabe Plotkin, chose to hold. They believed GameStop was still overvalued even at $40 or $50. They thought retail investors would eventually lose interest and the stock would crash back down. They would wait it out. This decision would cost them everything. Brighton hedge funds saw what was happening and started covering their shorts. They took losses but got out before it got worse. Some even flipped and went long, buying shares to ride the squeeze. These funds would profit while Melvin Capital and others who stayed short would be destroyed. The financial media struggled to cover the story fairly. Many anchors and analysts had close relationships with hedge funds. They couldn't believe retail investors could be right and professional hedge fund managers could be wrong. The narrative on CNBC and Bloomberg was often skeptical of Wall Street bets and sympathetic to the shorts. But this bias backfired. It made retail investors even more determined. They saw the media as part of the establishment that was rigged against them. When analysts said to sell, they bought more. When hedge fund managers complained about manipulation, they laughed and bought more. The traditional levers of influence didn't work. Ramifications amplified everything. Twitter, Facebook, Instagram, TikTok, GameStop content was everywhere. People who had never invested before were downloading Robinhood and buying shares. The movement was growing exponentially. And that's where we'll pick up in part 2, because what happened next changed everything. It exposed the rigged nature of the stock market. It led to congressional hearings. It created a movement that still exists today. And it proved that when regular people unite, they can take on Wall Street and win. This was the setup. The pieces were in place. A dying company that wasn't actually dying. A brilliant entrepreneur with a vision. A regular guy who saw value where others saw nothing. A community of retail investors who refused to back down. And hedge funds who made a fatal mistake. Confined, the short interest was a ticking time bomb. The retail buying pressure was the spark, and the explosion was about to happen. In part 2, you'll see how high the stock actually went, what happened when brokers restricted trading, how much money hedge funds lost, and what the aftermath means for the future of investing. Horrified, the stage was set for the greatest short squeeze in stock market history, and nothing would ever be the same. If you want to see what happens next, watch part 2 where we cover the explosion, the trading restrictions, the billions lost, and the aftermath that's still unfolding today. Subscribe so you don't miss it, and if you found this valuable, leave a comment with your thoughts on the GameStop saga. Did you participate? Do you think retail investors were right or reckless? Let me know in the comments below. Thanks for watching. When we left off, GameStop was at $76. The squeeze was building. Retail investors were winning. Hedge funds were bleeding, and nobody knew how high the stock could go. What happened next would break the internet, trigger congressional investigations, and expose the rigged nature of the stock market. This is part 2. The explosion, the restrictions, the billions lost, and the aftermath that's still playing out today. January 26, 2021. GameStop opened at $88. By the end of the day, it closed at $147, a gain of over 80% in a single day. The squeeze was accelerating. Trading volume was insane. Over 170 million shares traded that day. To put that in perspective, GameStop's entire float of tradable shares was only about 50 million. The stock was trading more than 3 times its entire float in one day. That's how intense the buying pressure was. Wall Street Bets was in full celebration mode. Posts flooded the subreddit. Screenshots of massive gains. People who had invested a few $1,000s were now millionaires. Lives were being changed in real time. The community was euphoric. Keith Gill posted an update. His position was now worth over $47 million. He had turned 53,000 into nearly 50 million in less than 2 years. And he was still holding, still not selling. The community went absolutely wild. The media coverage reached a fever pitch. Every major news outlet was covering GameStop. CNBC had near constant coverage. Bloomberg, Fox Business, even mainstream news networks were talking about it. The story had transcended finance and become a cultural phenomenon. Celebrities were getting involved. Elon Musk tweeted support. Mark Cuban praised the retail investors. AOC, the congresswoman from New York, tweeted about the situation. This wasn't just a stock story anymore. It was about power, fairness, and whether the system was rigged. But behind the scenes, the financial system was straining. The Depository Trust and Clearing Corporation, the DTCC, is the organization that handles the settlement of stock trades. When you buy a stock, the DTCC manages the process of transferring ownership. This normally happens smoothly in the background, but with GameStop's extreme volatility and volume, the DTCC was facing unprecedented risk. They require brokers to post collateral to guarantee trades will settle. The collateral requirements are based on volatility and volume. With GameStop going parabolic, those requirements were exploding. Robinhood, the most popular broker among retail investors, was facing a crisis. They needed to post billions of dollars in collateral to the DTCC, but they didn't have billions of dollars. Robinhood was a relatively young company that had grown fast but wasn't hugely profitable yet. On the evening of January 27th, Robinhood's executives held emergency meetings. They were crunching numbers, talking to the DTCC, and trying to figure out what to do. The collateral requirements for the next day's trading would be in the billions. They couldn't meet them. They had a few options: raise emergency capital, restrict trading in certain stocks to reduce collateral requirements, or shut down entirely. They chose option 2, January 28th, 2021. This is the day everything changed. GameStop opened at $265 in pre-market trading. The momentum was unstoppable. Everyone expected it to hit $300, maybe $400 when the market opened. Then, right before market open, Robinhood announced they were restricting trading in GameStop and several other volatile stocks. Users could sell their shares but could not buy new shares. The buy button was literally disabled. The reaction was immediate and explosive. Retail investors were furious. This was the squeeze. This was the moment they had been waiting for. The shorts were on the ropes, victory was within reach, and Robinhood just pulled the plug. The conspiracy theories started immediately. Robinhood was owned by the hedge funds. They were protecting Citadel. They were manipulating the market to save billionaires. The accusations flew fast and furious. The reality was more complex but equally damning. Robinhood wasn't directly owned by hedge funds, but they did have financial relationships with them. Robinhood makes money through something called payment for order flow. They route customer orders to market makers like Citadel Securities, who pay Robinhood for the privilege of executing those orders. Citadel Securities, run by Ken Griffin, was one of Robinhood's biggest revenue sources. Citadel Securities is separate from Citadel the hedge fund, but they're both founded by the same person. And Citadel the hedge fund had invested over $2 billion to bail out Melvin Capital, the hedge fund that was getting destroyed by the GameStop squeeze. So you had a situation where Robinhood, which made money from Citadel Securities, which was connected to Citadel the hedge fund, which had bailed out Melvin Capital, which was short GameStop, decided to restrict trading in GameStop. The conflict of interest was glaring. Robinhood's CEO, Vlad Tenev, claimed the decision was purely about meeting DTCC collateral requirements and had nothing to do with protecting hedge funds. But the optics were terrible, and many people simply didn't believe him. When the market opened on January 28th, with buying restricted on Robinhood, GameStop's price started falling. It opened at $265, briefly spiked to $483 as some buying continued on other platforms, but then began dropping as selling pressure overwhelmed buying pressure. Without the ability to buy on Robinhood, which had millions of retail investors, the squeeze momentum was broken. The price fell to $112 during the day before recovering somewhat to close at $193. The damage was done. Other brokers followed Robinhood's lead. TD Ameritrade, E-Trade, Webull, and others all restricted trading in GameStop to various degrees. The entire retail investor base was suddenly cut off from buying the stock at the crucial moment. The Wall Street Bets community felt betrayed. They had played by the rules. They had done the research. They had identified a legitimate opportunity. And just when they were about to win, the game was rigged against them. The system had shown its true colors. Social media exploded. The outrage was universal. Even people who had never invested and didn't understand short squeezes were angry. The principle was clear. The little guys were winning, so the powerful changed the rules. It confirmed every suspicion about Wall Street corruption. Lawsuits were filed immediately. Class action lawsuits against Robinhood for market manipulation and breach of fiduciary duty. Dozens of lawsuits from investors who claimed they were damaged by the trading restrictions. The legal battles would last for years. Politicians got involved. Both Democrats and Republicans condemned the trading restrictions. Alexandria Ocasio-Cortez and Ted Cruz, political opponents on almost everything, Both agreed this was wrong. That's how clear the injustice seemed. Maxine Waters, the chairwoman of the House Financial Services Committee, announced there would be congressional hearings to investigate what happened. This was now a matter of national interest. Congress was going to get answers. But what about the hedge funds? Melvin Capital, the biggest short seller of GameStop, was destroyed. They had lost over 50% of their assets in January. The exact number was never fully disclosed, but estimates put their losses at over $4 billion. Gabriel Plotkin, Melvin Capital's founder, had to be bailed out by Citadel and Point72, another hedge fund. They invested $2.75 billion to keep Melvin Capital afloat. Even with the bailout, Melvin was devastated. They would eventually shut down completely in 2022. Other hedge funds that were short GameStop also took massive losses. Some lost hundreds of millions. A few went out of business entirely. The total losses to short sellers in January 2021 were estimated at over $20 billion. $20 billion lost by professional hedge fund managers who supposedly knew what they were doing. Lost because they got greedy and shorted more than 100% of a company. Lost to a group of retail investors coordinating on Reddit. This was unprecedented. Retail investors had always been seen as dumb money, the suckers at the poker table. Wall Street was supposed to be smarter, more sophisticated, better informed, but in this case, retail investors had outsmarted Wall Street and won. Of course, the victory was incomplete because of the trading restrictions. Many people believe if Robinhood hadn't restricted trading, GameStop would have gone to $1,000 or higher. The squeeze would have been even more devastating to short sellers. Retail investors would have made even more money, but even with the restrictions, the message was sent. Retail investors were a force to be reckoned with. They could coordinate. They could move markets. They could take on Wall Street and inflict real damage. The financial power structure had been challenged. On February 18, 2021, the congressional hearing took place. It was broadcast live. Millions of people watched. The witnesses included Vlad Tenev from Robinhood, Ken Griffin from Citadel, Gabriel Plotkin from Melvin Capital, Steve Huffman, the CEO of Reddit, and Keith Gill, better known as Roaring Kitty or Deep Fucking Value. Keith Gill's testimony was the most anticipated. Here was the regular guy who started it all, the person who had turned $53,000 into over $47 million, the hero of the Wall Street bets community. What would he say to Congress? Keith appeared via video from his home. He wore a suit and tie. He looked nervous but composed. When his turn came to speak, he delivered a calm, measured statement. He explained that he was not a financial advisor, just an individual investor who did his own research and made his own decisions. He stated clearly, "I like the stock." Yes, that phrase became legendary. Simple, straightforward, and completely legitimate. He believed GameStop was undervalued. He invested based on his analysis. There was no manipulation, no conspiracy, just an investor who believed in his thesis. At one point during the hearing, there was a technical glitch, and Keith's video froze. When it came back, he said the now famous line, "I am not a cat." This was a reference to a viral video of a lawyer who accidentally had a cat filter on during a Zoom hearing. The moment provided some levity and became an instant meme. Keith's testimony was compelling. He came across as genuine, intelligent, and thoughtful. He had done nothing wrong. He had invested his own money based on public information and shared his analysis with others. That's not illegal. That's just investing. Vlad Tenev's testimony was less well received. He claimed Robinhood restricted trading solely because of DTCC collateral requirements. He denied any coordination with Citadel or hedge funds. He insisted Robinhood acted to protect the firm and its customers. Congresspeople grilled him. Why did you restrict buying but not selling? Why did other brokers handle it differently? Why didn't you communicate better with your users? Vlad's answers were often evasive and unsatisfying. Public opinion of Robinhood plummeted. Ken Griffin from Citadel testified that his firm had no role in Robinhood's decision to restrict trading. He stated that Citadel Securities had actually been a net buyer of GameStop during the squeeze, facilitating customer orders. His testimony was smooth and professional, but many people remained skeptical. Gabriel Plotkin from Melvin Capital testified about the losses his fund suffered. He denied doing anything improper. He said short selling is a legitimate investment strategy, and his firm followed all rules and regulations. He claimed Melvin Capital had closed out its GameStop position and was no longer short the stock. The hearing didn't result in immediate legislation or punishment, but it put the issues on the record: payment for order flow, market structure, the power of retail investors, the conflicts of interest between brokers and market makers. These topics would continue to be debated. After the hearing, GameStop's price continued to be volatile. It dropped back down to $40 by mid-February. Many people who bought at the peak lost money. The media narrative shifted to focus on retail investors losing money and getting hurt, But the Wall Street Bets community didn't give up. They continued to hold their shares. They continued to believe in the company's transformation under Ryan Cohen's leadership. And they continued to believe another squeeze could happen if enough people held. Ryan Cohen was officially named chairman of the board in June 2021. He brought in a new executive team, former Amazon and Chewy executives, people who understood e-commerce and technology. The company started transforming for real. GameStop paid off its debt. They raised capital by selling shares. They invested in new fulfillment centers and technology infrastructure. They launched NFT and blockchain initiatives. Whether these moves would ultimately succeed remained to be seen, but the company was no longer a dying retailer. It had a future. Keith Gill made one final update in April 2021. He exercised his call options and bought more shares, increasing his position to 200,000 shares. Then he went silent. No more updates, no more YouTube streams. He had become a legend and he walked away. His final position was worth tens of millions of dollars. He had achieved generational wealth for his family, and he had inspired millions of people to believe they could take on Wall Street. His legacy was secure. The aftermath of the GameStop saga continues to unfold. Robinhood went public in July 2021 with a disappointing IPO. Their reputation never fully recovered from the January trading restrictions. Users fled to other platforms. The company struggled. The SEC investigated the GameStop situation and released a report in October 2021. The report found no evidence of illegal activity by retail investors. It confirmed that the trading restrictions were primarily due to collateral requirements, not coordination with hedge funds, but it also raised concerns about market structure and conflicts of interest. Some regulatory changes were proposed, shortening settlement times to reduce collateral requirements, more transparency around short interest reporting, restrictions on payment for order flow. But as of now, most of these proposals haven't been fully implemented. The Wall Street Bets community remains active. They continue to focus on GameStop and other stocks they believe have squeeze potential. The culture of diamond hands and holding against Wall Street persists. Some people made fortunes, others lost money, but the movement changed something fundamental. Retail investing exploded in popularity after GameStop. Millions of new investors opened brokerage accounts. Investing became more democratized. The average person felt empowered to participate in markets that had previously seemed inaccessible or rigged against them. But there are also concerns. Some critics argue that Wall Street Bets promotes gambling behavior and encourages unsophisticated investors to take risks they don't understand. There have been stories of people losing life savings. The line between investing and gambling can be blurry. The fundamental questions raised by GameStop remain unanswered. Should short sellers be allowed to short more than 100% of a company's shares? Is the market structure fair when brokers can restrict trading to meet collateral requirements? Does payment for order flow create conflicts of interest that harm retail investors? These are complex issues without easy solutions. But GameStop forced them into the public conversation. It exposed the plumbing of the financial system, and it showed that when the system is stressed, the rules can change in ways that favor institutions over individuals. The GameStop short squeeze of January 2021 will be studied for decades. Business schools will teach case studies. Regulators will reference it when considering reforms, and investors will remember it as the moment retail investors proved they could move markets. Was it a successful squeeze? Yes and no. The stock did squeeze. Short sellers did lose billions. Retail investors did win in many cases, but the trading restrictions prevented the squeeze from reaching its full potential. The victory was incomplete. What's the legacy? GameStop proved that coordination among retail investors is powerful. It proved that social media can move markets. It proved that David can fight Goliath, even if Goliath can change the rules mid-fight. And it proved that the financial system still has structural problems that need to be addressed. GameStop is still a company with a future to determine. Ryan Cohen is still working to transform it. Some investors still hold their shares, waiting for another squeeze or for the company's transformation to succeed. Others sold and moved on. But the story of GameStop will never be forgotten. It was the moment when millions of regular people stood up to Wall Street, when a community of internet strangers organized to take on billion-dollar hedge funds, when the little guy actually won, even if only partially. The anger and frustration that fueled GameStop still exists. The belief that the system is rigged against regular people is stronger than ever. And the next time a similar opportunity arises, retail investors will be ready, because GameStop wasn't just about one stock or one squeeze. It was about power, about fairness, about whether the market served everyone or just the wealthy and connected. And those questions matter far beyond one video game retailer.
Keith Gill summarized it best with 3 simple words: I like the stock. That's all it took. One person who did the research, believed in their thesis, and shared it with others. Millions followed, billions of dollars moved, and Wall Street was forced to take retail investors seriously. The financial world will never be quite the same. And that's the real legacy of GameStop, not the money made or lost, not the specific squeeze, but the proof that when people organize, when they share information, when they refuse to back down, they can challenge the most powerful institutions in the world, and sometimes they can even win. Thank you for watching this deep dive into the GameStop short squeeze. If you enjoyed this series, subscribe for more content on the biggest financial stories that shape our world. Leave a comment below with your thoughts on GameStop. Did you participate? What do you think it means for the future of investing? I'll see you in the next video. But there's more to this story that deserves to be told. The individual lives changed, the other stocks that got caught up in the frenzy, the long-term implications for market structure, and the ongoing saga that continues to this day. Let's talk about the other meme stocks that rode GameStop's wave. During the same period in January 2021, several other heavily shorted stocks experienced similar squeezes. AMC Entertainment, the movie theater chain, saw its stock explode from $2 to over $70. BlackBerry, the former smartphone maker, went from $6 to $28. Bed Bath & Beyond went from $17 to $53. These stocks all had similar characteristics. They were struggling companies that many considered destined for bankruptcy. They had high short interest, and they had retail investor communities on Wall Street bets and other forums rallying around them. The playbook from GameStop was being applied to other stocks. AMC became particularly significant. The company was genuinely at risk of bankruptcy due to COVID shutting down movie theaters, but retail investors saved it by buying shares and giving the company access to capital. AMC's CEO Adam Aron embraced the retail investor community. He called them apes affectionately and made decisions based on their feedback. This created a new dynamic. Companies that would have failed were being rescued by retail investors who liked the stock regardless of fundamentals. Was this rational investing? Not really. Was it powerful? Absolutely. The retail investor community had discovered they could influence not just stock prices, but actual business outcomes. The term meme stock entered the financial lexicon. These were stocks driven more by social media momentum and retail coordination than by traditional valuation metrics. Financial analysts struggled to understand how to value them. How do you put a price target on a stock when the price is driven by community sentiment rather than earnings? Some institutional investors started paying attention to social media sentiment as a legitimate factor in their analysis. Hedge funds hired people to monitor Wall Street bets and other forums. Algorithms were developed to track retail trading patterns. The retail investor had become too important to ignore, but with great power came great risk. Many retail investors, especially those who got involved later in the squeeze, lost significant money. People who bought GameStop at $300 or $400 saw their investments drop 70 or 80%. When the stock crashed back down to $40, there were heartbreaking stories. People who invested their children's college funds, individuals who maxed out credit cards thinking the stock could only go up, families torn apart by financial losses. The euphoria of January was followed by the despair of February and March for many. The media coverage shifted from celebrating the ITIC, retail investors taking on Wall Street, to warning about the dangers of meme stock investing. Financial advisors cautioned against following social media for investment advice. The narrative became about protecting people from themselves, but the Wall Street bets community pushed back against this paternalism. They argued that retail investors had the right to make their own decisions, even risky ones. Nobody complained when hedge funds lost billions on bad bets. Why was everyone so concerned when retail investors took risks? There was also a class element to the criticism. When wealthy people gambled on complex derivatives and caused the 2008 financial crisis, they got bailed out. When working class people bought stock in a company they believed in, they were called irresponsible and reckless. The double standard was glaring. The psychological impact of GameStop extended beyond finance. It became a symbol of a broader cultural movement. The distrust of institutions, the desire to fight back against perceived unfairness, the power of community organizing through social media. These themes resonated far beyond the stock market. Some sociologists and cultural critics saw GameStop as part of the same energy as other recent movements: Occupy Wall Street, the Bernie Sanders campaign, concerns about wealth inequality. GameStop gave people a way to directly fight back against the financial elite rather than just protesting. The fact that it was organized on Reddit, a platform known for grassroots organizing and anti-establishment sentiment, was significant. This wasn't institutional organizing. This was organic, bottom-up, chaotic, and democratic. Everyone had an equal voice. A teenager could post analysis that got as much attention as a professional investor. The culture of Wall Street bets also challenged financial orthodoxy. Traditional investing wisdom emphasizes diversification, long-term thinking, and risk management. Wall Street bets celebrated concentration, short-term plays, and maximum risk. The ethos was YOLO, you only live once, go big or go home. This cultural shift worried many in the financial establishment. They saw it as promoting financial illiteracy and dangerous behavior, but others saw it as democratizing investing and challenging the gatekeepers who had kept ordinary people from participating in wealth creation. The debate over payment for order flow became central after GameStop. This is how Robinhood and other free brokers make money. They route customer orders to market makers like Citadel Securities, who pay for the privilege of executing those orders. The market makers profit by capturing the spread between bid and ask prices. They can do this because they see the order flow and can position themselves advantageously. Critics argue this creates a conflict of interest. Is the broker really getting the best execution for customers, or are they prioritizing the payment they receive from market makers? Robinhood and others defended payment for order flow as enabling commission-free trading. Before Robinhood, retail investors paid $7 to $10 per trade. Payment for order flow allowed Robinhood to offer free trades, which opened up investing to millions of people who couldn't afford commission costs. But GameStop exposed the hidden costs. When Robinhood restricted trading to meet DTCC collateral requirements, it revealed that free trading isn't really free. The system has costs and risks that get passed to customers in non-obvious ways. Some regulators and politicians called for banning payment for order flow. They argued for a more transparent fee structure where customers paid directly for trading rather than having hidden arrangements with market makers. But this would likely mean the return of trading commissions, which could reduce retail participation. The debate continues. There's no perfect solution. Every market structure has trade-offs between cost, transparency, access, and efficiency. GameStop forced these issues into public debate in a way they never had been before. The DTCC's role also came under scrutiny. Why did collateral requirements spike so dramatically? Was the 2-day settlement period outdated? Could technology enable instant settlement that would eliminate the need for massive collateral? Some blockchain and cryptocurrency advocates argued that traditional finance is fundamentally broken. They pointed to decentralized finance, or DeFi, as an alternative. If stocks traded on blockchain with instant settlement, the GameStop situation wouldn't have happened. There would be no clearinghouse requiring collateral. But DeFi has its own problems: lack of regulation, extreme volatility, technical complexity, hacking risks. The idea that blockchain could solve all the problems of traditional finance is oversimplified, but GameStop did highlight that the current system has serious issues. Ryan Cohen's transformation of GameStop became a fascinating subplot. He brought in Matt Furlong as CEO, a former Amazon executive. He hired other talent from Amazon, Chewy, and leading tech companies. The company pivoted hard toward e-commerce and digital. GameStop invested heavily in its website and app. They improved delivery times. They expanded product selection beyond games to include PC components, gaming furniture, collectibles, and electronics. They shut down underperforming stores and focused on profitable locations. In 2021 and 2022, GameStop also ventured into NFTs and blockchain gaming. They launched an NFT marketplace and invested in Web3 initiatives. This was controversial. Some investors loved it as a forward-thinking move. Others saw it as a distraction or a cash grab jumping on a trend. The NFT market crashed in 2022 and 2023. GameStop's NFT marketplace didn't gain significant traction. The blockchain gaming initiatives largely fizzled. This aspect of the transformation strategy appeared to fail, but the core business improvements were real. GameStop's e-commerce sales grew significantly. They reduced costs. They built up a war chest of over $1 billion in cash. They had financial stability that would have been unimaginable in 2019. Was the company worth its stock price? That remained hotly debated. At various points, GameStop traded with a market capitalization of over $10 billion. For a company with annual revenue of around $6 billion and minimal profitability, that seemed high by traditional metrics. But the bulls argued GameStop deserved a premium valuation because of its transformation potential, its brand strength, and the loyalty of its retail investor base. They also pointed to the remaining short interest as evidence that another squeeze could happen.